And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the second best day of the week. That's right. It's Thursday. Getting ready to wrap up not only the week, but wrapping up the month of February. Getting ready to start the month of March, which also wraps up the quarter. So we're quickly moving through, kind of this year so far in the first quarter. Today we've got some big economic prints coming out today. GDP fourth quarter revisions coming out today. And then tomorrow, of course, is PCE inflation. That is the Personal Consumption Expenditure Inflation Index. That's expected to come in a little bit weaker than what we printed in the last quarter, but that's the one thing that the Fed really pays close attention to. So that will move markets tomorrow. And speaking of moving markets, markets are up today, at least so far this morning. After the Nvidia report last night, we'll get into some of those numbers here this morning. Came in, they did beat earnings on top and bottom line, but the growth rate is slowing down because of the size of the company. But again, the left market's kind of unimpressed. So Nvidia is trading about flat this morning, but markets are going to be up overall because it did pull some pressure off the markets, and we'll talk a little about that in just a second. Outside of that, which is kind of the big thing that happened last night, and kind of really looking at the economic news today, one of the things that we're going to look at going into the next quarter is we've pretty much finished up earnings for this quarter. I mean, Nvidia is really kind of the last big print for earnings. We'll get a few more companies out over the course of the next few weeks, but we're going to start earnings again already in April. So, I mean, just as we finish this up, that means earnings coming. That also means that the stock buybacks are about to go back into blackout. Right now, about 93% of all companies are in their open window for doing buybacks. That has been providing a bit of a bid to the market, but that's going to close here shortly. So again, as we start getting later into the month of March, we'll start seeing buybacks begin to fade away. But this brings up a really interesting thing. Mike wrote an article yesterday about behaviors and investing behaviors, and we write a lot of stuff about psychology, investing rules, those type of things all the time because it weighs so much on how you do in the markets, right? And it's interesting. The markets are down about 3.5% from the peak, right? It's about 3% from the peak. That's not much of a decline. But if you take a look at the retail investor psychology right now, it's about as bearish as it's been at any kind of big major correction bottom. In other words, you've had a very small correction here, but investors are very, very bearish. The CNN fear greed gauge over an extreme fear right now. But there's been a lot of devastation. MicroStrategy is a good example. It's down about 50% from its peak. That's the Bitcoin company that, MicroStrategy invests in Bitcoin. That's kind of the whole business model. That stock's down about 50%. People that were buying the 2-for-1 leveraged version of MicroStrategy are down way more than that. That's gone from like 26 to 5. So it's had a huge decline. And again, this has just been in just recent weeks. I mean, this hasn't been over a kind of extracted period. It's been a very, very sharp decline in some of these high beta momentum names. Bitcoin, after having a double top at 100,000, is down to about 85,000. So we're seeing kind of this risk off rotation in the markets, and that's something that we're going to talk about right now as we discuss what you need to know before the bell this morning. So again, talking about the markets first, let's start with the S&P 500. And we talked about yesterday that we were coming down, we're setting on support at the 100-day moving average. Kind of important that we hold that. And in today's daily market commentary, so if you go to the website realinvestmentadvice.com or on our Substack page at Lance Roberts, our daily market commentary is out. And I go through this analysis right here and explaining a bit about using stop losses. This is one of the tricks that happens with stop losses is that you break the 100-day moving average. Let's say that was your stop loss level. I like moving averages for stop losses because they trail the price of the stock. you break it and immediately you sell it, and then the market immediately turns around and gets back above that moving average. We broke it yesterday morning, right? Another sell, right? No, back above it by the end of the day. So again, this is what you want to get, and I kind of go through that example and explain kind of how to use stop losses in this type of environment. You've got to give it a little bit of time here for the markets to sort itself out. This morning, markets are going to open higher. But again, we've had a very small correction here. Markets are getting very oversold here. Sentiment is very negative. We're getting set up from a contrarian basis. We're getting set up for a decent little rally here in the markets probably over the next couple of weeks. So again, you've got so much negative bias right now. That's a contrarian signal for markets typically, and typically turns into a market reaction to that, which reverses that sentiment. So again, it's not guaranteed, but again, retail investors are super, super bearish. Now, at the same time, we've had a very nice rally in bonds. Bonds have about an 8% lead over stocks so far this year, which is kind of interesting because again, you know, where the stock market is now, bonds have been doing very, very well. But they are approaching the 200-day moving average from underneath. They are getting overbought right now on a pretty good basis. So again, I would expect a bit of a pullback here, probably back towards on TLT. Expect a pullback to around 90. If it can hold that support level, work off some of this overbought condition, that should eventually give the bonds the ability to make that push above the 200-day moving average as economic data continues to weaken. And we're certainly seeing that in a lot of the economic data that's coming out. We're seeing that trending growth of weakness, economic growth heading back towards 2%. That's going to pull yields back towards 2% eventually as well. But again, they're not going to go there in a straight line. And unless you have some type of, you know, kind of economic event or some type of market related event that causes a real shift into safety over risk, it's likely going to take a while for yields to come on down. But again, they are heading in that direction, and we're starting to get a more and more kind of technical support for lower yields in the markets. But we talked a little bit about Bitcoin a minute ago, and this is kind of where we are. Bitcoin came down, challenged the 200-day moving average, bounced off that a little bit yesterday. So again, that correction is not surprising, but you know, this is the one thing we've talked about previously, is that Bitcoin is really a proxy for risk, and it's a proxy for the S&P 500. So while you've had about a 3% decline in the S&P 500, you've had about a 15% decline in Bitcoin. So again, it's kind of a leverage bet on equities. And so as you get these, and then this is the problem with volatility, is that when you have a lot of assets that are highly correlated to each other and some act as a leverage bet on something else, when the one kind of proxy declines a bit, you get a much bigger roll-off in those kind of leverage bets against that. And that's what you're seeing with Bitcoin, MicroStrategy, those type of things. Those leverage bets are paying a price right now. And again, it doesn't mean, you know, that the trade is over, but we've had a big correction here. Bitcoin is very oversold. I would expect a rally here in Bitcoin, and if you get that rally in Bitcoin, that's that risk on proxy. That should translate back into higher prices for the S&P 500. So again, you've got a really good setup here for a bit of a rally in the markets just to reverse some of the short-term negativity. Now, even if your view is that the markets are going to go through a bigger correction at some point this year, that's certainly possible. But you're not going to do that in a straight line, and not going to do that without some type of kind of exogenous event, something to really impact the markets. Tariffs aren't the issue. Everybody knows about the tariffs. As those come along, the markets are processing those. You've got to have some type of break to create that much bigger blow off in the markets. And again, you've got such negative sentiment and oversold conditions right now. That's going to likely result in at least a short-term tradable rally to take advantage of. So again, you know, if you're looking to take on risk, right, and leverage risk, you've got a decent setup in things like Bitcoin right now. If you want a more kind of just normal trade, the S&P is in a good position right now here for a bit of a rally, and we should see a bit of that recover. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz. We'll talk a little bit about Nvidia's earnings yesterday, what that means for the markets. I also want to talk about liquidity in the markets. Some interesting dynamics going on in the bond market with the Fed, with QT, with reverse repo. We'll talk a little bit of that with Michael Leibowitz this morning. Don't go away. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just a little bit about Nvidia yesterday. Nothing overly exciting. They did come in. They beat earnings estimates. Nvidia, I'm going to read just a few of the kind of the snippets from the earnings report. Nvidia's net income hit a record high of $22.1 billion in quarter four. That's an 80% increase over last year's quarter four net income of $12.3 billion. One of the things that's kind of dragging a little bit on the stock this morning, I guess, and again, it's just pretty much trading flat at the moment, is just, analysts are going, well, the growth rate is slowing. Well, no kidding. When you go from 12 billion in sales to 22 billion in sales a year, it's going to be really unlikely you're going to go to 44 billion in sales next year. I mean, there's just a limit. It's the law of large numbers it's very easy to go from $1 million in revenue to $1 billion in revenue, have explosive growth in revenue. It's much tougher to go from 1 billion to 2 billion. So, as they always say, the first million is the hardest to make. Talking about margins, one of the major concerns about Nvidia is that earnings growth rate is slowing, and I'm now reading to you from Goldman Sachs. Seemingly exponential revenue growth was supercharged by the soaring forward profit margin from a low 35% in 2023 to 56% in 2024. Progress is stalled and the margin is narrowing, if anything, ever so slightly. Nvidia's guided non-GAAP gross margin was 71% versus in the current quarter, and that was just below the consensus of 72%. However, now here's the big however to all of that. So seeing a bit of slowing there in legacy products. Here's the catch line here, which was the company has said that the margin will widen once again new products like Blackwell reach the market. Now, they did $11 billion in sales in Blackwell chips in the last quarter. Now, remember, this Blackwell just came to market last year, late last year. It was around August, September of last year. So, again, the Blackwell is the newest chip to this AI kind of generational space. And that just really came in. They did $11 billion in sales in that already. While the slowdown's a bit of concern, one thing to note is that price to sales has fallen from 50 times price to sales to 29. So they've had a big surge in increase in sales. At the same time, the stock price has gone nowhere in about 6 months. So again, it's been very stabilized kind of price growth that's allowed sales to catch up. And as Mike wrote about in his recent article on kind of, what is a value stock, you've got, a company like Nvidia trading at less than a 1x PEG ratio, which is price to earnings growth. So again, just really explosive earnings growth. The price has been stalling here. So again, this is really kind of, setting Nvidia up. This kind of long sideways grind has been working off a lot of that excess in the stock, which will allow the stock to start growing again along with earnings. So anyway, with that, let's bring Mike in. Good morning, Mike. How are you?
I'm doing great. Thank you.
Good
to be here.
So just kind of running through Nvidia's earnings again, kind of a muted response to, beating earnings yesterday, at least for Nvidia. Now, the rest of the market's doing well this morning. It was kind of the big worry yesterday for us. And as we were looking at the portfolios was, what if they miss earnings, right? What does that mean for the whole market? That worry a little bit off the table for right now. Nvidia this morning about flat on the earnings news, but did you see any takeaways last night?
No, they beat it pretty much across the board. Like you said, margins were a hair short of expectations, but the numbers are just unbelievable, the growth numbers. The problem for Nvidia is these are the growth numbers the market has been talking about. So they're doing great. They got an A on their report card. They're meeting expectations. They're doing well, but the market has priced this in. So, all those years of the stock tripling and quadrupling and going up and up and up, we're in anticipation of where we're at today. So it's harder and harder for Nvidia to truly beat, even though they beat expectations for everything, revenue, profits, even forward guidance. They didn't beat it by enough. It becomes very difficult when you've gone up as much as Nvidia shares have gone up to really wow people. So, this is why technicals are so important, because when the stock was leading the fundamentals, you had to buy into the narrative that they were going to do this. Well, now they've done it. And so you have to follow technicals to see when it's overbought, when it's oversold, when it's just right. Because if you're waiting for fundamentals, it's too late usually. You have to anticipate fundamentals, but you also have to anticipate that their margins, their growth rates cannot continue at the rates they've been going at. So the market's kind of transitioning from the let's price the stock off an incredible growth rate to let's price it for more of the reality for the next 5 years. That growth is not going to be as easy, and margins will probably have to shrink at some point.
Right, and which is really interesting when you talk about Nvidia that way, right? And then you compare it to a company like Apple that really hasn't grown revenues in 5 years to any great degree, but the stock price is continuing to rise, right? But it's not growing at 100% a year. Right. I mean, you buy Nvidia last year, you're up 100%. That's not happening with Apple. But and my point here is that there's been a lot of talk about Nvidia. Maybe the AI thing isn't really the thing. And one thing that Nvidia did address yesterday is that they expect demand to increase over 100 times for their chips, particularly with autonomous driving and robots. That's going to drive a huge demand for their business because those all require GPUs as well, and chips and everything else. So, they're going to eventually, to your point, migrate to this growth rate in the stock price that's more tied to the growth rate in earnings. In other words, instead of the stock going up 100% a year, it's going to be 10, 15, 20% a year, kind of it's going to start to align itself with returns in the markets more than anything else, right? Just because the growth rate is going to slow, but that doesn't mean the price of the stock is going to crash. It just means that the price of the stock is going to just start to rise more in line with the growth rate in earnings.
Right, and here's what's interesting. I believe they announced a 1 cent dividend. So at 1 penny is nothing, but it shows you they're starting to think about paying back shareholders in a different way other than the stock price, right? So At some point, Nvidia is going to become a cash cow like Apple. So why does Apple stock keep going up despite the fact that its revenue has been relatively flat? Because they're buying back shares. So the value of each share, because there are less of them, representing the same earnings, profits, revenue, margins, whatever, there's more of it per share.
Right.
We're going to start transitioning into that for Nvidia, I anticipate. And maybe this 1 penny dividend is their way of telling the market that, look, we're going to start fortifying you in other ways other than massive growth. We're going to pay you a dividend. That dividend, now they're set to increase that dividend
right,
at the next quarter.
Yeah, I was just going to say, so their current dividend yield is about 0.03%. Which that doesn't sound like a lot, but it's something, and they're going to increase that slowly over time. And they are doing buybacks, right? So, and to your point, they're going to keep increasing those buybacks. They'll start increasing the dividend more. And, in the next 10 years, Nvidia may be, the type of company that's, throwing off a 2% dividend yield and is more of a steady kind of growth company like a Microsoft or like an Amazon or like an Apple.
Right, but if Nvidia is buying back shares, but a lot of it is just offsetting executive options.
Sure.
So if you look at their share count, it's pretty much flat, whereas Apple's clearly in a downward trend.
Right.
So, you can anticipate a day where Nvidia is only, and I say only in quotes, growing 20%, 15%, but they're buying back 5 or 10% of their shares a year. So, you take 15% earnings growth and 10% share buybacks, and you're up to 25% growth, which for a more mature company is incredible.
Right.
So there's still a great future, but I think we're transitioning from it being a massive growth story to more of a sustainable story.
Right. And look, and that's healthy. It does have that does have an implication for the market itself. And really, this kind of goes in, when we talking about Nvidia, it's Apple, it's Microsoft, it's Google, it's Amazon, it's Tesla, it's Nvidia, it's those companies, right? That Mag 7. Again, we go back to this discussion we've had before is that, when you look at the top 10 stocks of the index, they absorb about 40% of every dollar invested into all these benchmark ETFs, whether those are leveraged ETFs or, just S&P indexes or mega cap growth indexes, all these kind of indexed ETFs that are trying to figure out some way to slightly beat the S&P 500 or give you some variation of the S&P 500. They all own the same stocks, right? You look at all those, they all own those same stocks. Those stocks will continue to get those flows. So as long as investors continue to put money into the markets, into those ETFs, that's going to continue to support the prices of these big companies. So a lot of these people betting that, Nvidia is the next, Enron and it's going to crash. That's not going to happen in this market that we have today. Could we have big corrections in the market? Sure, absolutely. You need some event to cause that to occur. But for people betting against Nvidia, it's been a losing bet for a very long time, and it's probably going to continue to be that way going forward because this isn't the late 1990s in artificial intelligence. It's a bit different this time because these companies are generating massive revenue that they weren't doing before. All right, quick break. We'll come back. We've got to switch gears here, talk a little bit about liquidity. Some interesting things going on with reverse repo, the Fed's QT, bond issuance in terms of the government, trying to cut back on spending. It's an interesting balance on what's happening in liquidity in the markets. Talk about with Mike when we come back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my daughter has friends. Her parents actually raised chickens. And so the family had to go out of town and they asked my daughter to go over and just watch the house, check the dog, check the chickens. So the first day she goes over there, one of the chickens dies. Chickens die all the time for different reasons, but I didn't tell her that. I'm like, oh my God, you killed one of their chickens? She goes, I don't know what happened. I just walked in to check the chickens and the chicken died. And so she's in a panic for like 3 days while this family's gone. I'm just leaving this thing and run, right? You need to go over there and fess up that you're a chicken murderer.
The Real Investment Show podcast.
She's in tears. She's devastated. She goes over there and she's like, I have to tell you, I killed your chicken. And he goes, honey, they die all the time. It just happens. That's why there's so many of them out there. It's a numbers game.
The Real Investment Show podcast. Same show, your schedule.
She didn't speak to me for 3 weeks.
At realinvestmentadvice.com.
But I had a lot of fun with that one.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Larry's at work in our chat this morning making Gene Hackman jokes. If you're not aware, Gene Hackman, his wife and dog passed away. They don't expect foul play right now, but he was 95 years of age. Interesting byline of that is that one of his probably most notable movies was Hoosiers, about the Indiana basketball team. And he was convinced when he made that movie that it was going to be a complete bomb. And turned out he was mildly surprised at how successful that movie was. But Gene Hackman has a very long and storied career. And Larry did not know what a Hoosier was. So we're gonna have to educate Larry a little bit. So Hoosier mama. Exactly. Exactly. So anyway, he will be missed. Gene Hackman made great villains. He made great heroes. So he just made a lot of really great movies. So anyway, talking a little bit about liquidity in the market. Some interesting things that are going on right now. We talk a lot about reverse repo. We talk about the Fed's QT. We talk about debt issuance, the need for more debt issuance. All that creates liquidity, right? So in some shape, form, or fashion. And, the whole purpose of QE was to provide liquidity to the banks during, periods of financial stress. Reverse repo was there to, provide liquidity for the banks in times of stress, those type of things. You remember the bank term funding program, right? So the regional banks got into trouble, so we created a funding program for them. So it's all about liquidity in the markets, and we talk. We've shown you before. We created a liquidity index that looks at the Fed's reverse repo, minus the Treasury general funds, and it kind of gives you a sense of where liquidity is in the markets. And typically that's had a very high correlation to asset prices. It's been deviated as of late, which is an interesting kind of byline to all this, because markets have been doing something that they don't normally do, which is deviate widely from a liquidity. But it is interesting, and Mike and I were having a bit of this conversation yesterday. And Mike, let's just start with reverse repo, which is now basically gone for all intents and purposes.
Important to appreciate what that program is, or what it was, sort of. So the Fed just flooded the economy, Wall Street, banks with liquidity in 2020. And they did it to avert what they thought at the time was going to be an all-out depression. The economy globally was being shut down. People were scared to leave their houses. So they just flooded everything with liquidity. And they purposely, I believe, put out too much liquidity. So what they had to do was take some of it back, but not permanently, just kind of keep it in a bank. And the reason they had to do this was because with all that liquidity chasing a limited number of investment assets, primarily we're talking money market assets here, treasury bills, that type of thing, interest rates would have gone well below zero. And the Fed at the time wanted Fed funds at zero. They didn't want minus 2% Fed funds, or, a 2-year treasury yielding minus 1%. That creates a whole host of other problems. They would have put the whole money market fund complex out of business. It would have been a whole different sort of crisis going on. So they resurrected their overnight reverse repurchase program. And basically what it is that the money markets and the banks can lend money to the Fed, and in exchange, the Fed will give them collateral, treasury collateral. So it's as risk-free of a loan as you can get, and you're lending it to the Fed. Not only lending it to the Fed, but it's collateralized with treasuries. So it's about as risk-free as you can get. So the way to think about that program was the extra liquidity in the market. The market didn't need it. And that's why the Fed introduced the program, to take that out, but keep it as a bank of liquidity. So we've been able to track it. They publish this, I believe it's daily or every few days. And every day there's an auction for the repo. And yesterday's auction showed that this is overnight repo. So whatever the latest auction is the balance of the program, because it matures every day. It was 0.003 billion, which is, what's that, 30 million? Mm-hmm. So it's 30 million. This is a program that got up to about 2.4, 2.5 trillion in late 2022, but has since 2023 has been steadily declining as the market has been basically taking the extra liquidity and using it. The market's demand for liquidity has been increasing, and it's been coming from there. Now, the other kind of tricky part of this equation is that the Fed is doing QT. So when the Fed's doing QT, they're essentially putting bonds back into the market, sucking liquidity out. So what the Fed has been able to orchestrate for the last couple of years is they've been able to do QT without taking out liquidity from the market, because QT and the repo facility have more or less offset each other. So when you look at kind of like these standard measures of liquidity, they've pretty much been flatlining for the last 2 years. Again, because QT has been offset by the repo program. So the problem is the repo program is gone. So the way to think of that is not that liquidity is gone, that we have a liquidity problem brewing, but there's no more liquidity in our savings account. So this pool of liquidity is not there. And at some point, the markets will need extra liquidity. And at this time, the Fed's taken away liquidity. And the reason this has become important is because in the last Fed minutes, so in the Fed minutes, so the Fed puts out their statement when Jerome Powell speaks, the same day when they tell you what rates are doing. But then they put out their minutes 3 weeks later, and in the minutes they said that several participants suggest halting or slowing balance sheet reduction pending debt ceiling resolution, which makes sense, right? If we're going to have some sort of fiscal debt, quote unquote, crisis, then the Fed should kind of provide a little more liquidity to the market. In other words, not take away liquidity during that period. It sounds legitimate, except if the federal government is not issuing debt. When the federal government issues debt, they're essentially taking liquidity from the market. So they're draining liquidity. And at the same time, the Treasury has a savings account at the Fed. They call it the Treasury General Account. They're draining that account and pumping liquidity into the markets. So there's money, there's liquidity coming in from the TGA. The Treasury isn't issuing. So part of the liquidity equation that a lot of people use includes the TGA. So with the TGA pumping liquidity into the markets, you would think they would still want to do QT to offset that extra liquidity. And that's where it kind of gets a little confounding, that I would think they'd keep QT at least initially unless there are problems. And what it tells me, I think, is that the Fed is looking beyond the debt ceiling, and they realize that the overnight reverse repurchase store of liquidity is gone, that the market doesn't have it anymore. There's no more extra liquidity. Now QT going forward is going to drain liquidity the way it kind of supposed to, the way it should. And that's a potential problem. And I think they want to get ahead of it. And they're, in the words of, and I researched this, it's either Rahm Emanuel or Winston Churchill. No one can really pin it on anyone, but never let a good crisis go to waste.
Right.
And I think that's the Fed is trying to get ahead of a potential liquidity shortage. Well, I'm not saying that they see one right down the road, but I think they're trying to get ahead of it this time versus 2019, where they did see it coming and did nothing.
Right. And I guess that was
too late.
Yeah, and that was kind of my question, which was, it seems to be almost a setup where, you're just waiting for one thing to impact the market, and all of a sudden the Fed's got to immediately start to kind of reverse. They've got to cut rates. They've got to start restarting liquidity again. And what I kind of imagine them doing is they'll keep QT in place, focus on rate cuts first, and then go back to QE. But it's interesting that they've paused QT for right now, kind of while they work through this debt ceiling thing. But that kind of seems like a really convenient excuse not to go back to doing QT at some point.
Right. And again, they just proposed it. They didn't do anything yet. But it's a precarious position where the Fed is right now, because if they just said, no mention of the debt ceiling, we're going to stop doing QT, or we're going to think about lowering rates, the term premium, the risk, the fear in the bond market would spike again, right? Oh, the Fed's being dovish. Now they're going to generate inflation. Right. And so they have to be really careful about policy. And I think they want to stay kind of on the we're not doing anything to even we're a little hawkish side of the equation. Removing QT is very dovish. Right. So it's a tough situation for them right now.
Yeah, I agree. All right. Well, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So we write often on our website about investing psychology, investing tools, investing rules. And these are all, important to remember because, when we get kind of into the heat of the moment of the markets, et cetera, we tend to kind of forget the basics of what drives good investment decisions long term. So Mike and I write about this stuff quite often, and it's more of a reminder for us than it really is for you. We share these with you to help you be a better investor over time, to remind you of the really the traps and the pitfalls that we get ourselves into. And and especially when markets are, being very bullish, it's easy to kind of forget about the rules of risk management. When markets are declining a bit, it's easy to forget about the rules of, longer term investing and how our psychology leads us to make bad investment decisions. And it's just human nature, right? So it's just something we have to always be cognizant of. And this is why Mike and I kind of rewrite this stuff every now and then. It's more, as I said, more of a reminder for us than it is even for you. But we do publish this for you so that you have access to it. It's all on our website. You just go to the website, realinvestmentadvice.com. If you put in the search bar at the top, behavior, rules, trading rules, anything like that, you'll get numerous articles on these type of things. Well, it's interesting right now in particular because, again, we've had this 3% decline since the peak. We were just at all-time highs. The market pulls back 3%. And if you take a look, as I was mentioning this earlier in the show today, but if you take a look at the American Association of Individual Investors, their level of bearishness is at levels more normally associated with a market crash. I mean, it's very, very bearish. The bull-bear spread is very negative right now. There's no bulls, they're all bears. And that's very much a cycle. And again, the markets are just down 3%, right? It's not like we've just been through a 10% correction like we had last year, in last summer. During the whole yen carry trade blow-up, markets were down 8.5%. The year before that, we were down 10% during the summer. And this is even more negative than we saw back then. And again, it's just been a very, very small decline. But this is where investors start making those bad decisions. I can tell you just here at our little shop, we've had numerous clients call us like, when are we going to start selling? Right? This market's about to roll over. When are we going to start selling stocks? It's like we haven't triggered anything technically yet. I mean, you're still above moving averages. The trend is still in place. We've been in a big consolidation, but that's that psychology, right? That's that one of the very basic behaviors that we fall trapped to is called loss aversion. And we start taking action to try to avoid loss. But sometimes that creates even a bigger problem. So anyway, Mike wrote a whole article on behaviors, kind of behavioral analysis on Wednesday. So Mike, you just want to kind of tell us a little bit about it?
Yeah, well, it seems like this could be the kind of year where we get a lot of volatility and the market goes nowhere. Right, so the S&P ends up or down a few percent, but at one point it may have been up 15% or down 15%, and we kind of go on that rocky road to nowhere. And in times like that, where you got a lot of volatility, you have to be as rational as you can. And one of the most important things to realize when you're talking about rationality is to realize that we are irrational human beings. Human beings are irrational. We're always making not the optimal decision. And some of it is we just don't have the information. And there's other traits too, like confidence or the way we treat gains versus losses. But the most important thing you can do is continually, and this applies to Lance and I, who have been doing this for 35 years. Lance, what are you on, 50 years?
Probably.
That's why I write these articles now and again, just to remind myself, because even though I've been doing this for a very long time, I have to remind myself to try to be as rational as you can. And Lance, when you were doing your little technical update this morning, I was kind of thinking about the rationality. Mm-hmm. And one easy way to help you become a little more rational, instead of, I got to go buy everything, I got to sell everything, and constantly flipping, your positions back and forth, is to take whatever it is you're looking at, whether it's the S&P 500, Nvidia, Bitcoin, a utility company, you name it, and look at that graph on many different time frames. So if you look at it on a 5-minute time frame, the thing, whatever it is, whether it's the sleepy utility or Bitcoin, it whips around all over the place. It's going up, it's going down, it's dropping. Then you start pulling out, look at it on a daily graph, a weekly graph, a monthly graph. So when you look at the S&P on a daily graph, you can see there have been a few decent down days. And, like you said, we're down about, 3%.
Right.
But when you start pulling back and looking at it weekly and monthly, you don't see anything. So the point is, we can't get caught up in the daily, even minute by minute, hourly gyrations of the market. We have to keep our focus on what matters: sentiment, fundamentals, geopolitics, macroeconomics, and not lose sight that there's a lot of irrational people, a lot of speculative people that are trading these markets and will cause it to fall 2 or 3% in one fell swoop, and just as easily cause it to rise 2 or 3%, in a matter of days, or day or days. So it's just keeping a level head and understanding where we can go wrong. Like one of the favorites that is a Kahneman won a Nobel Prize on is gambling, but it's also trading. When we have a gain, we tend to want to protect that gain and we start selling. When we have a loss, we tend to want to double down. So if a stock's working in your favor, you should double down. You should buy more. When it's going against you, get out of it. But as human beings in general, we do the opposite. We anchor ourselves to certain prices or ideas. I bought the stock at $55 a share. That must be its fair value. And if it goes to 60 or if it goes to 50, all of a sudden I'm conflicted without realizing that maybe the stock is now worth 50. And if I still like it, 50 is the value. And it's based on some new news that we have. So you can't get caught up in where, you really don't want to get caught up in where you bought the stock, but what's it worth now? And would I buy it again today? Is there value in it?
Right.
And obviously confidence is a big deal. We've seen the best of Wall Street tell you they only make about 60% of their investments or their trades are good. They lose on the others. Where they succeed is letting the good ones run, cutting the bad ones early enough so they don't kill them. And, I think at the end of the day, you have to check your confidence at the door, because the market, just like Nvidia, what was the most painful thing for Nvidia to do? It was nothing. The options trading on Nvidia was crazy, puts and calls, and all those options lost money. The people that wrote the options did well, but anyone that bought options thinking that the stock was going to go up 20% or down 20%, all lost money. The market tends to do what hurts the most people. So
yeah, that's pretty much the case. Yes.
So just remember, you're not rational. Lance is certainly not rational. I'm not rational. And the more you kind of just check yourself and understand where your flaws are, the better you can kind of manage your wealth, not get sucked into these days where the market's down 1.5 because there's tariffs coming and, there's all kinds of news that's scaring you. And conversely, not to jump in because Kramer says we need to buy Nvidia or Bitcoin or whatever his latest share is, latest stock is. Just, be rational. That's my advice.
And again, this is you have to always bring this back to time frames too, right? So kind of your position is, and my position is, we're longer term investors. So we're looking to buy positions that we want to hold for a long period of time. We're buying good quality companies. We're looking at long-term cash flows. We're looking at those type of things. And, we're wanting to build positions and hold them for a long period of time. But for instance, like in our portfolio, like we've owned Costco for a very long time. We've owned AbbVie for a very long time. Those have been great winners for our portfolio. But, they're not barn burners, but they just kind of grow every year with the portfolio. And when markets go down, they tend to hold up okay. But, that's our time frame. That's our duration. I mean, if you're a day trader and you're looking to just kind of really speculate in the markets and just, manage for quick returns, there's nothing wrong with that. People do it all the time. But, that's a different kind of set of technical tools that you have to use for that. But, and again, in that environment, managing your psychology is critical, because you've got to be totally unemotional. If you're day trading positions, you've got to be willing to cut losers really short. It's like, hey, I bought this position 5 minutes ago. It didn't work. I'm out and I'm off to the next trade. That's a much tougher environment psychologically to invest in, but it's doable. So your time frames are very, very important to what tools you use to manage your portfolio. But then, but across all of that, you have to manage the psychology. That's the one thing that gets every trader, every investor eventually over time, is just psychology and behaviors. All right, that wraps up the show for the day. Have a great day. We'll be back tomorrow morning, of course, with more of the Real Investment Show. Be sure to go by the website, like and subscribe to the channel. We appreciate it very much. And also follow us on Substack, @Lance Roberts. So all of our stuff there for you. All right, have a great day. See you tomorrow.